Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in our Washington, D.C. Policy on Demand studio, where I'm excited to have Steve Kohart back on the podcast. Steve is an international tax partner in PwC's New York City office and former advisor to the Center for Tax Policy Administration at the OECD. Steve, welcome back to the podcast.
Thanks a lot, Doug.
Always good to have you on. It is October when we're recording this. One of our two baseball teams that we follow is still in the playoffs, and it's your New York Mets, not my St. Louis Cardinals. My opening question for you, Mr. Kohart, do your New York Mets have what it takes to win the World Series this year?
Oh, that is a good question, Doug. They absolutely have what it takes. Will they get there? I think that's a hard question that we won't know the answer to for a little while.
It's when the people who are listening to this will have the benefit of hindsight. The Mets are still in it, playing in the playoffs currently. And when this gets published in a couple weeks, we may know. But Steve, your answer is absolutely right. You have to believe.
You got to believe, right? Believe. I mean, I'm a Mets fan. I mean, and but until game two, I would say, if we could just make every inning the 8th and 9th inning, we'd be good to go. But it's been a wild ride.
And the Mets had 89 wins this year. Last year, the Rangers, who won the World Series, had 90. And the Arizona Diamondbacks, who kind of snuck in, who rightfully got hot at the very end, they had 84 wins. And so 89 wins for the Mets. I will comment for those interested, my St. Louis Cardinals did not make the playoffs. The management has recently said that they will be resetting next year. Steve, they did not use the term rebuilding, but I will anticipate that the results for 2025 resetting may be substantially similar to rebuilding.
But it's all about the branding.
But it's all about the branding. But time will tell. I'll still be rooting and hopeful. All right, we can move on from baseball, which I know our international audience is very interested in, to a topic that they may be actually more interested in, which is Pillar 2. So before we dive in, and you've been on the podcast a number of times to talk about Pillar 2, we're gonna take it up a level, Steve, to remind listeners, what is Pillar 2? When your wife or your family asks who don't do this, what is Pillar 2, Steve?
Sure. So Pillar 2 is the global minimum tax agreed to by the inclusive framework at the OECD, a group of countries, a large group of countries, looking to impose under their own domestic law, essentially an interlocking system of a minimum tax based on financial accounting results. And it's a 15% minimum rate, but it's not as simple as just looking at a group's financial statement and saying, hey, what's their profit before tax and what's their tax expense? And is it 15%? There's a whole host of adjustments. It's a jurisdictional level calculation. We're going to get into a lot of the challenges with that calculation on this podcast today. But then, how is it collected? And a couple of different ways. One is it can be collected by the source country. So a jurisdiction can choose to adopt a qualified domestic minimum top-up tax, or QDMTT, where they impose a 15% minimum tax, almost like an alternative minimum tax on their own domestic tax base using Pillar 2 concepts. And then going up a level from there, if it's not collected by that mechanism, if there is a company up the ownership chain, if not the ultimate parent entity of the group, that's adopted what they call an income inclusion rule, it's a CFC-like rule that essentially looks down the chain from the highest tier that's adopted the rule, it could potentially be picked up under that income inclusion regime. And then lastly, and perhaps most potentially controversially, is the undertaxed profits rule, which is when it's the backstop rule. When all else fails, this tax gets collected in jurisdictions that aren't in the ownership chain, that are within the group, brother, sister, or up the chain, can collect the top-up tax, and then that gets allocated out amongst all the jurisdictions in the group that have adopted a UTPR based on tangible assets and headcount.
And we'll talk about some of the practical implications. So yeah, the QDMTT, or Qualified Domestic Minimum Top-Up Tax, allows a jurisdiction to collect the top-up tax on itself. The IR, the income inclusion rule, which we'll talk about, allows a parent company or an intermediary holding company to collect the top-up tax from its subs. And the undertax profit rule, in its infinite wisdom, effectively allows any related consolidated subsidiary who enacts these rules to collect the top-up tax from anywhere else in the group, subject to a whole number of exceptions. But Steve, what taxpayers are potentially subject to this rule? What is the revenue threshold?
So any group with revenues over 750 million euros in 2 out of the last 4 fiscal years.
So we now have, Steve, the OECD has said that they anticipate 40 countries that are implementing these Pillar 2 rules or have enacted the Pillar 2 rules in 2024. By our estimations, we're kind of in the mid-30s right now. I think 34 technically have actually enacted. Interestingly, there are 4 countries in the EU that have not yet formally enacted: Spain, Cyprus, Poland, and Portugal. And the EU Commission announced a decision to refer all 4 of those countries to the Court of Justice of the European Union. This feels a little bit like political blustering. All 4 of those countries have said that they intend to enact those rules, specifically the income inclusion rule, effective 1/1/24, so for this year. So I think some of that's political blustering, but we'll see. I think all 4 of those countries will get their acts together.
And I think that's also sending a message ahead of the UTPR effective date for next year that, Europe is serious about these rules. And for anybody who thinks that they're not going to try to enforce the UTPR, I think this highlights that countries that don't enforce the UTPR or don't adopt the UTPR are likely to face the same challenge.
Yeah, it's a great point. It's interesting as we think about, if there are 40 countries that are enacting these rules, 24 of those are sitting in Europe. And so there is certainly a perception, as I travel around the globe and talk to folks, that this really was driven and has been driven by the EU. And if you look at the numbers, one can reasonably make that conclusion. A couple of other recent announcements. I want to get your comment on one of those about 2025. So, the OECD has said that another 40 to 50 countries, which feels a little ambitious to me from what I've been reading and hearing, but another 40 or 50 countries will enact in 2025. Notably, Singapore has recently come out publicly and said that they are going to implement an IR and QDMTT in 2025. Switzerland, which currently has a QDMTT in 2024, recently said that they will implement an income inclusion rule in 2025. Very interestingly, Brazil introduced what they claim is a qualified domestic minimum top-up tax, and we're going to talk a little bit later in the podcast how we determine whether something's qualifying. That, I will acknowledge, is in Portuguese, and we're still getting it translated. I'm interested to see that language. And then also, which impacts a number of U.S. multinationals, Puerto Rico has recently put out a consultation document. Was hoping you could talk a little bit about that, because I think their twist might be a little interesting and different than what we've seen elsewhere in the world.
Absolutely. So Puerto Rico did recently put out a consultation document. They're still in the process of evaluating what a QDMTT in Puerto Rico might look like. I think one of the most interesting things they're seeking consultation on is whether or not it might be an optional QDMTT, where a group could elect in to the QDMTT. And it'll be interesting to see if they do decide to go down that route, how that plays out with the peer review process that we're going to talk a little bit about later. Because as a reminder, a QDMTT is supposed to have the same scope and applicability as the GLOBE rules or the Pillar 2 rules. So it'll be interesting to see if they decide to go down that road.
Yeah, and I mean, it's very important for these rules to work together that the QDMTT, the Qualified Domestic Minimum Top-Up Tax, which really comes out first as part of the calculation, really needs to mirror the income inclusion rule and the undertax profit rule, sort of one similar framework for this to all fit nicely together. And as we've spent a lot of time talking about, that's good in theory. And then in practice, it's a lot more challenging because some countries are making policy decisions to differ slightly. Just the timing of the administrative guidance we'll talk about. There are certainly some bigger differences than others as we actually look across the globe and start comparing these 30-something countries that have already enacted.
And especially for U.S. multinationals. I mean, look at Puerto Rico, right? If there's a QDMTT, if you're a U.S. multinational who's picking up your income in the U.S., if they don't have a QDMTT, or if you're not in their QDMTT, you can potentially allocate those U.S. taxes down into your ETR calculation. Whereas if you have a QDMTT, you can't take that allocation into account. So you can potentially get a very different answer in terms of how much your Pillar 2 top-up tax is. And can't always claim a foreign tax credit for it in the US.
Yeah, very important point. And that allocation of those guilty taxes, as well as the foreign tax credit implications for US multinationals, certainly impacts the math for that. And we dedicated a podcast, some of the guidance that we received from the US IRS and Treasury, that QDMTTs are good creditable taxes. We're an income inclusion rule. They've been silent on the UTPR, but the IR taxes are not. But your point on Puerto Rico is very well taken. If that is the only low tax sub or one of only, then typically speaking, the taxes under the model rules that are associated with guilty would get allocated down to the Puerto Rico sub and to potentially avoid a top-up tax, where that may not be the case with the QDMTT.
And if you wind up paying the QDMTT, you might not, even if it's creditable, you might not have the capacity in your foreign tax credit limitation calculation to actually use that credit.
It is certainly three-dimensional chess.
Indeed.
So, all right, so let's talk a little bit about where companies are. So we're into the Q4 now. We've seen a number of disclosures with respect to kind of quarterly year ends, and I think most multinationals have acknowledged in some respect that the impact of Pillar 2, some of it is more substantial than others. Obviously, a lot of it depends on where you operate, what incentives, and how much tax you're paying in each of these jurisdictions. But what are you seeing from some common themes as you're working with companies as they're starting to think about year end?
I think number one theme throughout the year has been the transitional CBCR safe harbors because of the tremendous compliance simplification that they are. I think the real challenge, though, with that is that it's CBCR based, and I think we'll talk a little bit later about some of the challenges of always being able to use the safe harbor. So it's a compliance simplification, but there's a lot of effort that goes into, do I have a qualified CBCR? Am I potentially running afoul of any of the traps for the UNWARY that came out in the December 2023 administrative guidance, and really getting comfortable that you can use your CBCR data to take a shortcut for the first year or two or three, depending on how long you can manage to stay in the safe harbor, and then getting your auditors comfortable that that's the calculation and data that you can rely on, and you don't need to go back another layer of the onion and do a full Pillar 2 calculation on the jurisdiction because there may be some concerns about the quality of the CBCR report.
Yeah, that's a real risk, is that, I think it's important early to engage with stakeholders, including financial statement auditors for those public companies, because the additional work that needs to be done for a full globe calculation and the volume of data that is needed is just a lot different than the transitional safe harbor rules and the country by country report. So, for those taxpayers that need to do the full calcs, you got to start early because getting the data can be a big exercise. Certainly, making sure you have a qualifying country by country report can be a big exercise too. But any particular challenges or themes you're seeing from a data readiness perspective, to the extent that a company, for example, operates in Ireland or a jurisdiction that is below 15% for whatever Pillar 2 reasons?
I think it's finding a reliable source of the data that they're going to need for that full Pillar 2 calculation and engaging with the stakeholders, because for example, substance-based carve-out, you need to know payroll, and you need to be able to double-click into it and really see, what's going into what's hitting the P&L. Are there things that provide benefit, tangible benefits to employees that aren't running through the payroll line?
Right.
And conversely, are there things there that shouldn't be there? And that's just one example where you might need to, engage with folks outside of tax and accounting around
multiple systems.
What's my Pillar 2 attributes going to look like?
Yeah. The other thing that I will note is that fiscal year taxpayers, and this is similar to what we saw in the U.S. with GILTI, end up with a little bit of extra time, but would caution all of them that this is a long, arduous process to start early and not get too lulled into, depending obviously when the fiscal year end is. So, Steve, one of the questions that I get a lot of is related to tax compliance. We know that the Globe Information Return is not going to be due until June of 2026, so we've got some time for that. There is a lot of uncertainty about when qualified domestic minimum top-up tax returns may be due. I think many of us assume that it will be also in 2026, although we know at least one country like Belgium has said that their QDMTT is going to be due next year. What are your views on the compliance process? What companies need to be doing? Where do you see this heading? Do you see, are we just going to have a whole mishmash of QDMTT returns around the globe?
Yeah, I think it'll be a little bit of all of it, right? Because we'll have likely QDMTT filings in all of the jurisdictions that have adopted a QDMTT. And then in theory, the global information return should only have to be filed once, either with the ultimate parent entity if it's in a jurisdiction that's adopted the rules, or in a designated filing entity in the case of a multinational that isn't headquartered in a jurisdiction that's adopted the rules. But in reality, the global information document published by the OECD indicated that when there's not an exchange of information agreement in place, or if that exchange of information is not happening, a jurisdiction with taxing rights can require a local filing. And maybe it's the cynic in me, but I expect that most jurisdictions with taxing rights are going to ask for a local filing of some sort. So we're likely to see very significant filing obligations. We've already seen this with the Belgian registration and the volume of data that they're asking for and the lift that is to pull together. And it's going to be much more granular than what M&E groups have needed to pull together for their quarterly or even year-end financial statement audit, because we're now talking about compliance grade data. And the global information return has a lot of information in it, from the org chart of the group to transactions entered into over the course of the year. It is a very heavy lift to pull that thing together.
Still feels less like a tax return to me and more of an information, a data request. But one thing I wanted to mention that you brought up was the Belgium registration requirement. I think this took many of us by surprise, and that the Belgian policymakers, and understandably, were looking for companies that are potentially subject to the Pillar 2 rules, whether it's the QDMTT or the income inclusion rule, that they needed to register in Belgium. And it was a bit of a fire drill.
It's a very short deadline that then got extended just a little bit.
And then I think the policymakers felt a little bit sympathetic with taxpayers and gave taxpayers a little bit more time. But talk a little bit about that process and specifically some of the volume of information just for the registration that was required.
Yeah, so Belgium went first with requiring this registration. And, originally there was only a little more than a month to get this done, and then it got extended. But the level of data required, and this is just an initial registration, this isn't even the global information return, required, for example, every intermediate parent entity in the group, regardless of whether that IPE held a Belgian constituent entity or not. And, I've helped a number of taxpayers work with our Belgian firm to pull together the data that they needed. And these are taxpayers that were well prepared for Pillar 2, that were doing their safe harbor calculations, doing their data analysis. And it was still a lift to get it done.
So we're going to get Peter Deer, who's our Pillar 2 sort of subject matter specialist in PwC Belgium, on a podcast to explain a little bit more. So stay tuned for that one, Steve. All right, I want to move to sort of some additional common issues, maybe traps for the unwary. I think the Belgian registration was an example of one that just kind of popped up and companies had to comply. I think from what we're seeing from a registration perspective, we're certainly more focused on that. Most of the countries that have a registration have given some time, so the registration won't be required until 2025, at least for most of the enacting jurisdictions. But we'll continue to keep an eye on that. Maybe some of the common issues and traps, maybe starting with the post-finalization of consolidated financial statements.
Yeah, so a lot of chatter in the multinational tax community about CBCR safe harbors and, do I have a qualified CBCR report, and what could potentially disqualify my CBCR report? And we've talked a bit about the guidance that we got in December, but I think it's really important to revisit it because we've seen groups continue to grapple with these rules over the course of the year as they've pulled together their safe harbor calculations. And one thing that was very clear from the December 2023 administrative guidance was, to the extent that you have adjustments that happen after you finalized your consolidated financial statements, those cannot be taken into account in the CBCR report. And the December guidance acknowledged that doing so would make the data more accurate, but nevertheless, they've drawn a line in the sand that if it gets made or pushed down after the consolidated financial statements are finalized, if that's what you're using as your CBCR data source, it needs to go into the year that it's made and not the year that it relates to. And that's one that I think a lot of folks need to watch out for, because running afoul of that could potentially disqualify your CBCR with respect to that jurisdiction.
Yeah, and one example of that is just post-period transfer pricing adjustments. I think another very common is just topside adjustments that occur. And in fact, from talking to a number of taxpayers, some of those topside adjustments can be very significant, and not pushing those down where they arguably economically belong can have a big swing on whether you actually meet the safe harbor or not.
Absolutely. And I think that's been a theme of a lot of the conversations we've had around trying to get your legal entity level data in the best possible shape that it can be before those consolidated financial statements are finalized.
Right. And that would be a process change that taxpayers would need to do just for the country by country reporting if they wanted to try to accelerate and avoid those post-period or those top-down adjustments. So just something else to be mindful of as part of that systems and data process for country by country. Obviously, also, there's a myriad of those issues for the full Pillar 2 calcs. All right, maybe another one is purchase price accounting.
Yeah. So again, this was the December guidance, and the purchase price accounting needs to be pushed down to the legal entity level. They call it the reporting package, which isn't a defined term in the administrative guidance, but is referenced as the data used to prepare the consolidated financial accounts that relates to the legal entity. So it needed to have been pushed down in your CBCR report for all years beginning after December 31st, 2022. And that's, I think, the one place where your 2023 CBCR report could be relevant to your 2024 qualification, because if you had purchase price accounting, it needed to have been pushed down in your 23 report in order for it to be in your 24 report and to have a qualified CBCR.
So thinking through that kind of multi-year process, we're going to come back to that as we think about for the U.S. and whether that needs to meet the CBCR. Before we get there, hybrid arbitrage. So we know these hybrid arbitrage rules currently apply for country by country reporting. We're waiting for administrative guidance. We'll get to this on the full Pillar 2 rules. But that hybrid arbitrage can apply on a whole myriad of situations, even though a particular taxpayer may not have had anything nefarious in mind.
Absolutely. There's no purpose test around those. Yeah. And thankfully, those don't relate to the CBCR qualification, but they do relate to whether or not you'll meet the safe harbor, because it's an adjustment that happens when you go to do your safe harbor calculation. So you don't make, I've had this question a lot, you don't make the hybrid arbitrage adjustment to if you're a US multinational, the Form 8975. It happens later when you go to prepare your global information return, but you need to have identified them to know if you'll meet the safe harbor or not, because in many cases will require an add back. And Doug, to your point, we've seen a lot of folks dealing with having to make add backs where there's no tax planning or no tax advantage being sought at all. It's just by virtue of the fact that the rules were drafted incredibly broadly and there's no purpose test associated with them.
All right. So the next one, which is another common question about whether the U.S. needs to meet the country-by-country reporting threshold in 2024, given the 3-year test. I guess maybe before we go there, start with what we commonly refer to as sandwich structure. So maybe you've got a U.S. parented group that has a CFC, a foreign subsidiary, and then maybe as a result of an acquisition, there's also a U.S. subsidiary below.
Very common fact pattern.
Very common, and imagine that CFC has an income inclusion rule. So what do U.S. taxpayers need to be wary of?
So in that case, right, if the U.S. is subject to the GLOBE rules, which means you have a U.S. constituent entity sitting under an income inclusion rule in 2024, it seems pretty clear that the U.S. needs to meet the CBCR safe harbor in 2024. And, the knock-on consequence of not meeting the safe harbor means that deferred tax assets related to tax credit carry forwards that might have been good under the transition period administrative guidance. So, think FTC carry forwards, R&D credit carry forwards, you potentially lose those because you don't get those under the full version of the rules. So I think in those structures, a lot of pressure on being confident that the U.S. is in the CBCR safe harbor for 2024.
And to remind folks, that has to be applied for not just the U.S. tiny U.S. sub that may be below that CFC with an income inclusion rule. It is done on
aggregate U.S.
It's a jurisdictional, and so you got to do that full calc. I think that has taken some taxpayers by surprise. But what about just for the general rule as we think about, because we have the UTPR safe harbor that applies to the U.S. when the undertax profit rule kicks in for next year. But what are we thinking about for U.S. multinationals in the U.S. group as that 3-year country by country safe harbor when they get into post the UTPR safe harbor?
Yeah. So, the wording in the December 2022 safe harbors document is a little ambiguous, but I think the better reading of that language is that because the U.S., if you have no U.S. entities subject to an income inclusion rule at all in 2024, I think the better reading is that because the U.S. isn't subject to the rules, it doesn't need to meet the transitional CBCR safe harbor for 2024. But that being said, in the conversations we've had with our clients, we said, look, if you could demonstrate that the U.S. meets the CBCR safe harbor in 2024, that's probably a good thing to keep a record of, even if it doesn't ultimately make its way onto the GIR, just as there is a little bit of ambiguity in that language.
Yeah, just one example of a number of kind of ambiguity and, how conservative do taxpayers need to be as they're thinking about complying. But I certainly think that's good advice.
And maybe just one last point on that is that, if a group uses the UTPR safe harbor in 2025, so it doesn't go through with the US CBCR calculation and testing that in 2025, they made it clear in the guidance that you wouldn't be able to use the CBCR safe harbor on the US in 2026. So I don't think in 2025 there's going to be many folks who are just going to push the easy button and use the UTPR safe harbor. I really think of that as a backstop. If you fail the CBCR safe harbor on the US in 2025, then think about flipping to the UTPR safe harbor.
Great advice. Maybe the last thing on sort of issues, traps, common questions we're getting, what role can local statutory financials potentially play from a Pillar 2 perspective?
So local stat can play a role both in the safe harbor calculations and in QDMTTs. Starting with the safe harbor, the December administrative guidance indicated that for purposes of your CBCR report, it's okay to use your local stat accounts if they're an acceptable financial accounting standard or an authorized one if the data's reliable. So, and they indicated that you could have different sources by jurisdiction. So you need to be consistent within the jurisdiction, but you could potentially use your consolidated financial accounts for 90% of your jurisdictions and your local stat for 10% because either the data is better or you believe it, more reliably reflects the outcome in that jurisdiction. There could be a whole host of reasons why you might want to consider using local stat as your CBCR data source for some of your jurisdictions.
All right. So what I want to move on to now is credits and incentives. And this, frankly, could be the topic of a whole separate podcast. But, what we've seen is policymakers around the globe have certainly used tax incentives as a way to be able to attract foreign direct investment. And some jurisdictions have had incredible success. Singapore is a great example for how corporate tax policy has really helped an economy. But what we know from the Pillar 2 rules and model rules and guidance, that it was their intention to really sort of end those types of incentives to stop some of that competition amongst foreign direct investment. And the guidance explains specifically that for a jurisdiction that's implementing a qualified domestic minimum top-up tax, that it prohibits a jurisdiction from providing, and I quote, any benefits that are related to the QDMTT or the GLOBE rules, close quote. Said another way, that the OECD was already concerned that certain jurisdictions may effectively amend some of their incentives or credits with what I think is now being referred to as kind of related benefits. We've seen a number of countries that have already started to talk about what their potential incentives may be. We've seen some reaction already from the OECD. I think Vietnam was like the first jurisdiction. This was almost over a year and a half ago, I think, where they popped up and mentioned. I think we're expecting some administrative guidance, but could you talk about just kind of the general state of play of where we are from an incentives perspective and if and when we may hear and how policymakers may react?
This has been a really hot topic recently. I think we saw some press recently where an OECD official had talked about potential future guidance on this topic. And, it'll be interesting to see where they choose to draw the line on what's an acceptable incentive and what's not. We've seen this sort of progression of thinking with the model rules, indicating that refundable tax credits are permissible. We have the QRTC treatment in the model rules where those are the quote unquote good credits, but your non-refundable credits dilute your ETR. Then we saw in July of 2023, the guidance on transferable tax credits and those now being a permissible incentive, I think largely in response to the Inflation Reduction Act. And then there's this question of how are they going to address incentives that some jurisdictions may be offering to continue to remain attractive to foreign direct investment in a post-Pillar 2 landscape. And I think it becomes really challenging to describe what's a good credit and what's a bad credit and what type of competition is permissible and what type isn't. So I'll be very curious to see what we get out of the OECD. It seems like we're likely to get something based on these comments, but I think it remains to be seen how they decide to draw this line.
Yeah, we'll keep a careful eye on that. I'm sure policymakers around the globe are keeping an eye on that. I will note for listeners, because we get this question a lot about the US R&D credit, where US policymakers still are out there saying that they hope or plan that the OECD, that the US R&D credit, which is non-refundable and sort of a bad credit under Pillar 2 standards, that apparently there is still some hope from the US administration that could change. I want to remind listeners that if you are a non-US parented group, a foreign parented group, and that jurisdiction has implemented an income inclusion rule, so anybody in the EU, Canada, Japan, South Korea, we have some very large foreign multinationals that own big investments in the US. Those R&D credits are bad credits for Pillar 2, and those income inclusion rules apply this year, and we are in October. So it's going to be very interesting to see if that's included as part of the guidance and if the OECD ever sort of deals with this R&D credit in the US. But it is a current issue today.
Yeah, and I think there's a conception among some folks that if they solve the R&D credit, that'll solve the UTPR problem for US multinationals. I don't think that's necessarily the case. It'll solve it for some US multinationals, but there are other things that can cause your ETR to be below 15% for Pillar 2 purposes in the US if you're a US multinational.
One of the other interesting things, Steve, that we're waiting on, and this is a long list, I appreciate, but is whether something is going to be qualifying, whether a QDMTT or domestic minimum top-up tax is going to be qualifying, or whether an income inclusion rule is going to be qualifying. And again, the reason that is important, because if a domestic minimum top-up tax is considered qualifying under the Pillar 2 rules, it effectively turns off the income inclusion rule for 2024. And then in 2025, when the UTPR comes in, it would potentially turn off the UTPR as well. We heard in a similar, I think it was one of the IFA conferences last month, where the OECD had made some comments on what could potentially be considered qualifying, and something that was referred to, that I had to Google this, a reverse consensus process to determine whether something may be qualified.
I thought this was fascinating.
Yeah. Can you tell us what does that mean, Steve?
Yeah. So I think it's a two-step process in terms of whether a QDMTT is a qualified QDMTT. And I think the first step that they had made clear was there will be this self-certification process, because they can't peer review 30 plus QDMTTs all at the same time in any reasonable speed. So the first step would be a self-certification. And I think a lot of folks had always found it curious that a country could just write anything and say, hey, I have a QDMTT, and then that would stand until there was the full peer review process potentially 2 years later. So what they've said now is there's going to be this objection period after the self-certification where in order to disqualify or knock out a QDMTT before the full peer review, you would need to have a reverse consensus, which would mean that every country except the certifying country objects, which seems like an awfully high bar.
Right.
I found this a really interesting choice, but nevertheless, that seems to be the direction they're headed. At least to me, I don't know, Doug, if you've heard, but I haven't heard much in terms of when exactly that's going to happen. I mean, we're 10 months into 2024 with QDMTTs in effect, and I haven't seen anything official around this process and when we might actually see a list of our good QDMTTs.
Right. And like even how countries can what is the process for the self-certification? Noticeably absent, but I'm in a lot of information that we need.
And to your point, I mean, real bearing on, well, what does a calculation look like? Because you need to think about, does that QDMTT turn off the other country's income inclusion rule if we have differences in how the rules are drafted?
Absolutely, because then all of a sudden that QDMTT turns potentially into a covered tax, right? Which is just very different in the ordering rules and the mechanics of the calculation.
Absolutely.
So hopefully we'll get some guidance on that. So that is actually a perfect transition, Steve, to what are we expecting next? And what can potential taxpayers expect? And we already mentioned that the list is long, but maybe I wanted to start with something that we've heard many interested parties talking about: permanent safe harbors. As you look into your crystal ball, any thoughts, or what are we hearing from a permanent safe harbor?
Yeah, so I mean, this has been on the radar for a while. We saw in the December 22 safe harbors document a potential framework for a permanent safe harbor, and we've heard continued public comments from the OECD and some member jurisdictions as well about the need for permanent safe harbors. And I think the June administrative guidance really underscores the need for a meaningful permanent safe harbor, because that thing is just so complex. I mean, I know it's not the subject of this podcast, but I've been working with a lot of taxpayers just understanding those rules and applying those rules on jurisdictions where realistically you're probably never going to have a top-up tax. Germany, right? I mean, it would take a really unique fact pattern. But these are really complex, dense rules, 100 plus pages for a small handful of topics. And I think that really underscores the need for a permanent safe harbor. And it seems as though there's a lot of commitment to it, or at least commitment to commenting on the need for it. But I haven't seen much in terms of actual developments on it. And I think we need it sooner than the end of the transitional safe harbors, because it's easy to fall out of a transitional safe harbor, even without a low rate, right? Release of evaluation allowance, for example, could cause you to fail the safe harbor and then need to do the full calculation for the next 3 years, even though you're in a high rate jurisdiction.
And the other point that I would make, Steve, is that taxpayers need to know if they want to invest in that process. So if they know that their country-by-country reporting process potentially has some issues because of the latest administrative guidance, how much time do they invest in solving that sort of data process versus just moving on to the full calc globe rules? And I think it would be helpful for taxpayers if they knew that those safe harbors were permanent, that they could invest in that process and accelerating what they need to do to make sure that they have a qualifying country-by-country report.
Or even if these safe harbors aren't permanent, the fact that there might be something based on CBCR where it's worth investing in that data.
Exactly. All right. So originally, I think when you were last here and we were recording in New York, the OECD had said that we could anticipate one more piece of administrative guidance. Well, we now have quite a long list of the least that the OECD has said. So what can we anticipate for future administrative guidance?
Yeah, so I think the list does seem to continue to grow. They committed in the December 2023 guidance about an anti-abuse rule for the full version of the rules, similar to what we received for the safe harbors, those hybrid arbitrage rules. And I know back in New York, we talked about some of the traps for the unwary there and how those can catch a lot of ordinary course transactions. So hopefully they use a bit of a sharper pencil and take a narrower approach when those come out. But I think that's something everybody's eagerly awaiting because it'll impact the full calculation.
We talked about the tax credits and incentives. So I think particularly policymakers and governments, they're also waiting. So this isn't just taxpayers, right? This is governments that are also waiting to see how they want to react. And then I think a couple of the other ones, if you want to comment, were mobile assets and how deferred tax assets related to controlled foreign corporations.
Yeah. So we received some guidance already on mobile assets and employees. It sounds like we may get some additional guidance with respect to highly mobile assets and things like that. We'll have to see what we get there. And then same thing in the June administrative guidance where we received these, in-depth rules about allocating cross-border taxes, both current and deferred. There was some language in there. There may be additional guidance coming with respect to the allocation of losses. So we'll need to see what happens there.
Yeah, and it does beg the question of when will this administrative guidance end? Will it end? And then how are countries going to continue to incorporate that into their domestic legislation? I mean, we've been talking about this for, over 2 years, but as we get further and further away, the ability for certain countries to be able to implement retroactive legislation past multiple years could be challenging for a number of legal and constitutional reasons.
Absolutely. And what one country considers a clarification, another might consider a rule change that they can't go retroactive on. And then we see differences depending on whose rules are applying.
The other interesting thing that I'm waiting to see, Steve, is challenges, right? We've already seen that there was a claim in Belgium that their UTPR was in violation of the EU standards. And so it's going to be very interesting, and particularly once the UTPR kicks in, I think there are some larger issues both with tax treaties and investment treaties, and it'll be interesting to see how that plays out.
Absolutely. I think the punchline there, though, is that all of those are going to take time, and we still have to deal with the rules as enacted today in terms of compliance and financial statement audits. So even if in the end a challenge succeeds, there's likely a long runway before then where we're complying.
It's a great point, and probably a great place to end things is that just because some of these may have some questionable legal footing, that the fact is that those returns are due again in June 2026, and all of these things take time, like all of these potential challenges. And so taxpayers are going to need to comply, even if there are some significant challenges to these rules. And again, just because the UTPR violates EU law doesn't mean, there are 16 other countries that have already enacted and, another 40 or 50 outside the EU. So a lot of uncertainty, but I think the advice is taxpayers are going to have to comply with this and because it is enacted rules.
Yeah, and I think there's a lot of legislation and legal developments that are going to need continued monitoring for the foreseeable future in this space.
And so that many more reasons, Steve, for you to come back and give us updates on Pillar 2 on the cross-border tax talks. Always great to have you on. Thanks for the update.
Thanks again for having me.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Steve Kohart, International Tax Partner at PwC. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.